we have now looked at control in pretty much detail, and we have concluded when there is control, it's a subsidiary and we will have to consolidate that subsidiary. Now, consolidation. A few accounting rules. Normally, the accounting policies of the parent and the subsidiary should be aligned. We will start with the consolidation process, include when control exists, and we will stop when control stops. Now, when does an entity not have to prepare consolidated financial statements? Number one, when the parent meets all the following conditions. Therefore, when you look at the right side, we have parent number one, which owns, let's say for example, 100% of parent number two, and parent number two owns 100% of S. Right. Now, parent number two does not have to prepare consolidated financial statements between parent 2 and S when parent number 2 is a subsidiary of another company, yes, of parent 1, plus debt equity of parent number 2 will not be traded, not listed on the JSE, or parent number 2 is not in the process of filing to trade publicly. They're not in the process to register to be able to trade shares publicly on the JSE. And when the ultimate parent, which will be P1, presents financial statements, group financials, or when P is an IAS 19 post-employee benefit fund plan. Okay. In terms of number 1 of IFRS 10 paragraph 31, the parent has to meet all of the conditions. Right. Then in terms of the process, very basic example provided to our full program students. My step number 1, I prefer to make use of my analysis owner's equity. It just helps me to ensure that I follow the process and that I do include all of the relevant details. Then a line-by-line combination. Now, what does this mean? Okay, if I take this one step back, I have P Limited. P Limited has an investment debit, investment in the subsidiary, 1,500. Okay, and I have S Limited. Now, combination means that all of the assets of P plus all of the assets of S, we need to combine. Combination, we combine this. Then step number 3, elimination and pro forma journals. Now, look at this. If we combine P and S, do you agree with me? In my group records, I will now have a line item, investment in subsidiary, 1,500, right? Okay, but you also agree with me. I've added all of the assets and liabilities of S Limited. Therefore, if I've added all of the assets and liabilities, I also have my assets minus my liabilities, my equity of S included in the group. Therefore, if I have the equity of S plus this investment amount, do you agree that we are double counting? Therefore, we will have to eliminate and take this out. If we take it out, we credit our investment. We debit the equity, which will be our share capital, retained earnings of S. We credit our investment, and we are able to determine if there will be a gain on bargain purchase or goodwill. Then step number 4, if you look at my process, eliminate intra-group transactions. Why do we do this? Remember, parent and subsidiary will now be seen as one entity. The parent cannot pay dividends to himself. Therefore, we will have to eliminate the intragroup dividends and then any other intragroup transactions. Right, now, if we look at this NCI, we will look at non-controlling interest. When we touch on IFRS 3, just your basic principles. Remember, your NCI, in terms of the accounting policy of the group, can either be at proportionate share or it can be at fair value of the shares. If it is at fair value, your NCI will share in the goodwill. If it's not at fair value, your NCI will not share in the goodwill. For our full program students, this is included in our basic example. Then in terms of goodwill, now when your net asset value exceeds the price paid, this will be a gain on bargain purchase. But when your net asset value of the entity is less than the price paid by the parent, this will be goodwill. And then when there's goodwill, it is important that you are able to identify what is the accounting policy of your NCI.